Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. And thank you for allowing us to do work that we find meaningful. Thank you for giving us the most valuable commodity you have, your attention. We promise to do our very best to give you a return on it. Today we have Danny of Capital Cosm on the show. Danny is a fellow YouTuber like ourselves, interviewing a lot of the same guests we do and looking at the analytics. I know that a lot of you watch both our shows. Today we're going to pick his brain on our favorite commodities. Danny, thank you for coming on the show.
Yeah, Steve, thanks for setting this up. It's a pleasure.
Yes, pleasure's all on this side of the table, sir. All right, go ahead and start out with just give us your story, a couple minutes on how you got into commodities and YouTube and how that led you to where you are today.
Yeah, so I run the Capital Cosm YouTube channel. We focus primarily on commodity investing, but we do kind of trail off every now and then, look at some crypto every now and then when, there's some interesting price action going on, a little macro as well. But really started the channel about a year ago. And actually, I officially opened my channel 4 years ago, back in 2020 is when I very much so got into investing, more specifically commodity investing. Obviously, 2020 was the year of, I don't want to get your channel in trouble, but the sickness, right? And we were all in house arrest, had nothing better to do. And I always followed things like the gold market and the oil market, listening to guys like Peter Schiff, Robert Kiyosaki, sort of like your mainstream alt finance guys, right? It's the first people that you find when you really get into this alt finance space, commodity space, those guys. But during the pandemic is when I really went down the commodity rabbit hole, the macro rabbit hole, etc. I started listening to a bunch of different YouTube channels out there. Really got into guys like George Gammon, Chris McIntosh, Justin Yoon, who else?
Rick Rule,
obviously, Jim Rogers, Doug Casey, all of these guys. And I have addictive tendencies. So when I really get into something, I really get into it. I just became like a madman, just absorbing as much info and charts and just watching as many videos as I could. And I began consuming so much data and content. I just had to get it out. Like it's just like a volcano. Like I had to talk to it. I had to talk about this stuff to somebody. And unfortunately, in my, I do hang around a bunch of successful people, but no one really was into this commodity thesis back then. So I had all this information. I wanted to get it out there. So then I started my YouTube channel. Back then it wasn't called Capital Cosm. It was just very early on. I mean, you guys can go to my channel, just like sort by oldest video. It's really cringeworthy. I disclaimer right off the top here. But I started the YouTube channel. But really wasn't proficient enough in the commodity space or confident enough in my abilities to actually talk about it on a consistent basis. So I took a little bit of a break, kept consuming content, and then, really got it, put some money into this sector. This is back in May 2020. Started, leveraging a lot of the stuff that I read from Uranium Insider, from Capital's Exploits, Chris McIntosh's newsletter, and just started learning from these newsletters, started learning from these people. And then come 2023 is when I really started to kick it up into high gear with my channel. We started covering uranium. That's when my channel really started to take on. Interestingly enough, when I first started covering uranium on my channel, this was coincidentally at the very bottom of the uranium. It was like spring or late winter of 2023. Like, when we bottomed out,
yeah,
we were at like $40 or something. And so whenever I post a video on uranium, I don't know if it was the same thing with your channel, but I would always get like these trolls and these self-hating uranium investors would always like comment and hate on uranium, like, oh, this guy's so late. The uranium trade is over. Like, you're so late, bro. Like, what are you doing? And in my mind, like, having learned all the stuff that I learned from, these smart guys like Rick Rule, etc., when you start hearing sentiment like that, that's typically a sign that you're at a bottom. Similar to when you hear people that you may have not have ever seen investing or heard of investing, trying to recommend you a stock, that's probably at top, right? When your barber starts recommending you stuff, crypto, et cetera, that's probably a sign of a top there. So that was really interesting. And so I just kept on the uranium stuff for a few months, and it really started to gain steam towards the end of the last year. So did the channel as well. And we're at 4,200 subs at the moment. Pretty good growth there. Happy to see how everything turned out. But yeah, I've gotten a chance to interview all these people that I used to watch passively on the screen, right? Because when you're watching these YouTube channels, you're watching YouTube content, it's a passive, one-sided relationship. You're only getting information from the expert. You're not you don't have the chance to ask them questions yourself and interact with them in a dialogue. So that was really cool, getting a chance to talk to people like Rick Roll, Jim Rogers, Doomberg, Justin Hune, John Polemy, all these, probably missing a few names as well out there that I highly respect. But nonetheless, being able to talk to all these experts was, worth it in and of itself. So I know I went on for a little too long there with an intro, but that's the gist of it.
Yeah, I kind of have the same tendency you do. What do you call it? An addictive tendencies. I mean, sometimes, especially when I wake up in the morning, I start staring at the charts, and then I got an interview later. I realize, it's 6 o'clock at night, and I never ate. So
Yeah.
I just get so dived into this. It's so much fun. Okay, let's start out a little macro view. One thing I like to ask of my guests: what is your macro view of the economy and financial markets as it sits today?
Yeah. So this comes at the backdrop of all of these various insiders that we've all been hearing about, like Jamie Dimon and the Walton family that owns Walmart and a few others, getting out of there, selling off their stocks. And while that might be interesting, you've got to keep it in context. These guys have billions of dollars in holdings, but they're selling off about 3 to maybe 4% of their total holdings. So everyone just kind of keep that kind of thing in context. But when you look at the macro as a whole, the yield curve has inverted, but historically, a recession or something of that nature doesn't typically occur until the yield curve uninverts, which it still hasn't. And you look at various other metrics like median housing prices. I don't have it pulled up now, but maybe I can pull it up here in a second. We've seen about a 15 to 16% drop in the cost of a U.S. median house sale prices here in the United States. And that's typically the type of precipitous drop that you've seen in prior housing crashes, let's say in 2008, and even before that as well. So there does appear to be signs that whether we may already be in a recession now, or because typically recessions are reported after the fact, right? And why am I bringing in housing to kind of tie it into macro and recessions? Is because here in America, the one of the biggest movers of credit is housing, right? These 30-year mortgage loans. And so there's a lot of interconnectivity there. But from what I've been kind of seeing is we probably already are in a recession, or we'll have one pretty soon, but it's probably not going to be reported. The way a recession is defined as 2 consecutive quarters. I know they've altered that definition over time, but it's probably not going to be reported until either late 2024 or early 2025. You're starting to see the Fed kind of walk back a lot of its rate cutting language that it used to prop up the market. The market's at an all-time high. The S&P just hit an all-time high a few minutes ago.
Yeah.
And you had Bitcoin shoot up to 63,000 or 64,000 at some point. Just a couple $1,000s off from its all-time high as well. You have gold shooting up at, what is it? It's at 29. It's just under $2,100 at the time of this recording. Oil shot up as well today, $80. I mean, these are all signs of. These are all inflationary indicators. So, and we can get into the fact whether we can still have a recession despite inflation. It's called stagflation. But the economy is, until that yield curve kind of uninverts, I kind of see us holding on to this kind of inflationary uh, moment in time. Yeah, inflation's gone down to what, 2-3% now, but it's when it goes down to these levels is when you start to see it heat back up again, right?
Yeah.
Remember when inflation shot all the way up to 7-8%, the market actually crashed with each huge headline blow to the inflation narrative. The market moves because it's the market is future looking, forward looking, as they would say. So when they see these low inflationary prints, that's actually bullish for the market. So because it sends a signal to the market that the Fed's gonna the Fed is going to cut rates. But I'm in the camp that thinks that the Fed will try to keep its hands off the markets at least up until the end of the elections. They're trying to run with this narrative that they want to be unbiased. Whether that's true or not, that's the line we've been told. So we'll see. But that's kind of my view of the markets at the moment.
Okay. All right. So you see, I think kind of like we do, that we could be in a recession right now, and since we changed the definition, and typically when you look back over history and you look at when the yield curve uninverts, they finally report the recession. Oh yeah, it started 6 months ago. Housing is coming down 15 to 16% for the average U.S. home. That's important for homeowners and just credit in general. And yeah, you basically see that over time, inflation is probably, we may have these intermittent pullbacks as we go, but generally speaking, inflation is probably going to continue higher.
Yeah, that's kind of my prognosis. You look at like the 70s, for example, you had these three humps. Pretty much, I mean, a lot of your audience has probably seen the chart there. We've had our first hump. Is it going to be 3 this time? I don't know. Might be 2, might be 4. Who knows? But what it basically tells us is that in a straight line, there's going to be ebbs and flows to this thing.
Yeah, yeah. Okay. What commodities, what sectors do you follow?
Yeah, so I have positions in almost every sector, but I'm weighed more heavily on the energy side of things just because, while all these commodities are pertinent to the sustaining of civilization and society and et cetera, it's really energy that's the backbone of the world that we know it today. So I really like uranium. I really like oil and gas, coal, nat gas. Those two in particular, I get the sense that are, if you want to gamble, those are probably the ones to speculate on.
Which two?
Nat gas and coal, just
Okay.
by virtue of the fact that they've been beaten up quite a bit. We can look at a few charts if you want. Really.
Yeah,
quick.
yeah. Let's pull them up. Let's start with uranium.
Let's see. All right, so you've got uranium here at 94.45. We had a pretty big pullback. I know a lot of uranium heads are sick of hearing the term pullback, but that's what it is. These are the monthly candlesticks. Monthly, as it goes with technical analysis, each candlestick represents a different time interval. I have it set on monthlies, but I could also have it set on weeklies. I could have it set on a daily candlestick. But what's interesting is, you look at the weekly here, you can see 3 or 4 consecutive weeks of precipitous drop here. You look at it on the daily here. The way UX1 reports it doesn't apply the candlestick methodology on the daily, but you look at it on the weekly here, you have 3 precipitous weeks. So why am I looking at it on a monthly candlestick perspective is because the larger the time interval where you see a discernible pattern, the more signal that it tells you. So when you're seeing the same pattern being applied to on a monthly candlestick versus a weekly candlestick, that has more confirmatory power to that move, whether it be an upside move or a downside move or a sideways move. Right now, we had a pretty strong red candlestick. We haven't seen a red monthly candlestick this big. And this is for the month of February, the most recently completed month here. But we haven't seen one this big in I want to say a decade. I really can't see any other red candlestick that big. So that's a pretty huge drop there.
Yeah,
But
the last one I
nonetheless,
saw was like 2011 there,
yeah, I mean, that could be one
right
right
there.
here.
Yeah,
Yeah, March 11th. So that's Fukushima.
yeah.
So, but we've got to look at this in context because this is coming off the backdrop of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 consecutive months of growth. So, there's got to be, and what's interesting here is you've got this quasi reverse hammer pattern. And it's not a hammer pattern. It would be a hammer pattern if the top of this green candlestick was a little lower down here, making the shape of a hammer. For example, this is a hammer pattern right here,
Yeah.
right? It's got a little it's got the candlestick at the top, and you've got a big whisker down here. What you're seeing here on the that the buyers were shut down by the sellers for the month of January. So that's a negative sign. That's a bearish sign. And what did you see after? You saw a big down month as a consequence. Now, when you look at this candlestick, this is October of last year. You had a hammer candlestick. That's a sign of that's a continuation pattern to the upside, and you saw that continuation pattern to the upside play out. So now this is kind of what we're seeing here, more of a rapid correction to the downside, given the fact that we had such a huge rise up to the top.
Yeah. Yeah.
Now, if you were to see this in reverse, right, when stocks or markets top out, they precipitously fall down, and then they have what's called a dead cat bounce for a little bit. So this could be the reverse of that. I don't know what you would call it, but you could see in the coming months, after this kind of resolves out, a resumption back to the upside, given the fact that the uniqueness of the uranium market, where these utilities have to buy uranium regardless of what the charts tell them. And the fact that I think it's like every additional $100 increase in the uranium price increases the electricity prices of these utilities by just a few cents. So it's very inelastic that way. But this is what we have so far on the uranium side.
And now you have a uranium sentiment chart, right?
Yeah. So right before we go into that, I just want to show your audience uranium when you price it. So we've looked at the nominal price, but when you price it against the actual money supply, the amount of money that's sloshing around in the system,
the M2 money supply.
Yeah, the M2 money supply. Now I'm going to switch this to get indexed to 100. So we may have seen uranium prices at, let's say, $150 in the 2007 spike, but we have a lot more money today than we did back then. When you control for that added money supply, now you're seeing that we've barely gotten off the mat here when it comes to the uranium price. So this is kind of like an inflationary control mechanism for the uranium price. When you look at this thing, we're at $94. That amounts to a 25-point ratio in the M2 money supply. Well, it doesn't tell us here, but it's about a 4x essentially. So you're looking at something in the ballpark of around the upper 300s, lower $400 to account and control for the money supply. And then, of course, you've got the US CPI that you can look at with respect to. And although this is a lot less dramatic, you're to kind of retrace back to these levels up here, you would have to see something along the lines of a 134% move. Now, this is just in the commodity price. As we all know, the miners, or the good miners, right, are supposed to capture that move and more when it comes to the uranium price. So you mentioned a little sentiment indicator. So what I pulled up here, this is from Google Trends data.
Oh, cool.
And yeah, so I've added in the term uranium stocks to this analysis.
Yeah.
What it basically tracks is the volume, the amount of search queries for uranium stocks. So how many people, or how many queries for the term uranium stocks are going out into Google from 2004 to today. And this is across the entire globe. Now, what you'll notice is if you index the top here in 2007 to 100, today it's 17% of that volume. So in other words, despite the internet adoption curve having grown immensely since 2007, something along the lines of we have 4 times more people on the internet today than we did back then, we're still only capturing 17% of that search query volume that we did in 2007. Now, why is this important? Because a lot of people, they try to gauge retail sentiment by, sentiment on Twitter, sentiment that they hear from their relatives, their friends. If your friend who's never been into investing tries to recommend you like a pot stock or something of that nature, that's your sign to get out, right? It's the classic greater fool's theory. What I'm looking at stuff like this is that it's data. It's telling you what people are searching exactly. Yeah. So you're not having to, kind of stick your finger out and see where the wind is blowing. You can see it here with the data. And what this tells us is that we're still far away from retail frenzy. Yeah, I mean, there's been a couple segments here and there on CNBC, but the public is really not that engaged with the uranium market. Yeah. And it's not even anywhere. I mean, it's still far away from even the tops that we saw in 2021.
Yeah.
Right.
Yeah.
So in 2021, we had about half the volume that we saw in 2007. And we're about at the same level, uranium stock wise, uranium stocks being URNM, URA, if you use those as a proxy, we're about at the same level as we were at those highs, but with much less retail fervor. So then it begs the question, and okay, then how could it be that retail has been unenthusiastic about this sector, but the price is pretty much the same as it was at the height of retail fervor in 2021?
Yeah. Yeah.
So this takes us to our next chart here. And this looks at institutional ownership of URA. Now we can also pull up URNM if you want, but URA is more of a long-standing ETF. And basically what it shows us is you've got your URA price here in black, right?
Mm-hmm.
And then these green bars tell you the amount of shares that institutional investors own. This is your smart money. These are your hedge fund managers, your family offices, etc. This isn't like your, uranium, typical average uranium account you see on Twitter. These are the guys that manage money. And the takeaway here is that despite the fact that URA, you look at the price here in what we have here, it's actually a little higher than it was in 2021, right?
Yeah.
But when you compare institutional ownership between today and back then, it's ginormous today versus what it was back then. So you couple this with the retail Google Trends data, and it basically tells you that when the price here was falling, this is telling you that it was retail that was selling into smart money. So dumb money selling into smart money, or smart money buying into dumb money, or it's, vice versa.
Yeah. Yeah.
So you may hear all this noise on X or Reddit or anywhere else on YouTube, but just keep in mind, these mofos, these institutional investors, despite the fact that URA dropped in February with the huge correction that we've had, they spiked up. They doubled down on their buying.
Yeah. Yeah.
Like you see this huge spike in February.
Yeah.
So, just kind of, this is what I like to kind of keep in mind is these are the people that know what they're doing, and they buy when the price goes down. And it's, so.
And that's very telling what you said too, right there, about if you look back in, December of 2021, there's 3 to 4 times the volume of institutional buying now than there was back then. Yet the price of the ETF is essentially the same.
Yeah, so that tells you that a larger share of uranium stock ownership is being held by institutional ownership.
Yep.
So by that same token, there's going to come a time when you're going to see these green bars start to go down as the price goes up. right?
Yeah.
It's the reverse, right?
Yep.
And that's when you start seeing this chart shoot up.
Yeah.
And in my opinion, that's my sign to take chips off the table.
Yeah.
Is when smart money sells off and retail buys in.
Okay. Yes.
So,
And what's the total market cap right now of uranium?
yeah, so we've got, so according to this site, it says 33 companies. I think it's a little bit more, but these are the largest uranium companies. It's sitting at just over $60 billion.
Okay. Okay.
Now, it's a good question because, as you'll recall, in 2007 and 8, the market cap got as high as $150 billion. So we're not even half of that. And actually, half of the market cap here, I mean, you look at the first two names,
Yep.
you've got Cameco at 18 billion and Kazatomprom 11 billion.
Yep.
So half of that market cap is just those two.
Yeah.
And the other remaining 30 to 35 million is your mid caps, right? Your developers, et cetera.
Yeah. Well, that's excellent news if we're holding uranium.
Yeah. Yeah. So
all right.
Yeah,
Let's continue with the energy thesis here, and let's move on to oil.
Oil. Okay. So oil has been spiking today.
Yeah, we're above $80 a barrel now. That's cool.
Yeah, yeah. So oil is about $80. We're at the monthly candlestick. Let's look at this on the daily. Yeah, we had a big green candlestick today. But oil's continuing to move in this channel. We want this, we want oil to break out of this channel here. And, we've got a few indicators we can look at. And I don't know. Oh, here you go. The distance from moving average. Whenever oil hits these higher levels of distance from moving average is when you have a sell-off here, right?
Yeah.
So you had a 38% deviation from the moving average here in March of 2022. What happened afterwards? You crashed. Similar thing here. Although the moving average wasn't as high, it was high enough to bring it down. So you had 15% deviations from the moving average. And so today you're sitting at a distance of 6.89%. So despite a pretty good move up in the oil price, there's probably a lot more to be captured. I suspect that once you hit this this resistance level here, you'll be something along the lines of 10% to, something along 10% away from the moving average. This is a key level here, this $84, $85 level.
Yeah.
So we'll see how it pans out. But the level that we're at now, you'll notice that there's a lot of historic buying and selling that happens at this level, right?
Yeah.
Especially here in 2022.
Yeah.
So,
a lot of price action around that level.
Yeah. So this is a pretty strong resistance zone. If we break through from that, then you're looking at the next obstacle, so to speak, is your $85 level.
Okay. And how are you playing the oil bet? Are you playing the ETFs? You buying Chevron? How are you playing it?
Yeah. So I don't buy ETFs, but I by virtue create my own ETFs.
Okay.
And what I mean by that is that I buy individual companies, and to the tune of like 5 to 10 companies. And so, studies have shown that, owning about 5 to 10 companies of a given sector typically gives you a pretty decent exposure to that sector, kind of like an ETF. I don't like ETFs as much as because there's fees involved. I'd much rather create my own ETF in the process. But I own the oil services companies. I don't own any Chevron or Exxon or anything of that nature, although they're probably safer. But the oil services companies, you're looking at, you get the big dividends, but they're even more beat up than your producers there. So,
okay.
Yeah.
And let's see, what about coal?
Yeah. So coal, do I have it here? Here it is. So coal has been in the dirt. No pun intended. Or actually, yeah. Coal's in, yeah.
So this is thermal coal.
Yes, this is thermal coal. Let's go ahead and pop over to a line to get a better view of things. Okay, so coal, you can kind of see here, coal's been dwindling sideways in this trading zone here. It goes all the way back to to 2021. We have a pretty strong support level here, but you can really tell the just the depression behind coal. So if you trace it back to its all-time highs up here, you're looking at a 3.5x.
Yeah.
Just on a retracement basis, and you're significantly down from the moving average here. You're only about 7% off the moving average. All the way up here in March of 2022, you reached as high as 120%. You doubled. You're at levels 2x times your moving average. So of course this thing was going to crash.
Yeah.
Which is what we saw here. You saw a similar thing here a year earlier in September of 2021. You were about 60% off your moving average, and then you saw a drop here, and then vice versa, right? You were 30% below your moving average, and then that's when you shot up. So right now we're kind of in a holding pattern. I will say that coal, much like natural gas, has been beaten up fairly significantly. Natural gas sitting at $1.83 right now. Switch back up to the candles, but long term, we are in this. This is a pretty strong support level.
Yeah, looks kind of like platinum right now. It's just in the toilet.
It's just bounce. I mean, this is like a trampoline, and anytime it hits the support level, it just bounces off. So this is where we're at now on the weekly candlestick. You'll notice that we hit it a week ago. We hit the support level a week ago, and we bounced right off. And we are 30% off our moving average. So short term, on a weekly candlestick basis, I think natural gas, just purely from a TA POV, has some better days ahead.
Yeah.
But these are more. I find that the oil service companies are there's a lot less. There's a better risk to reward ratio. But if this works, then you'll get more return than you would with something that's versus oil. So
yeah.
On more speculative basis, I'm looking at coal and natural gas, but I already have positions. I don't trade in and out. I'm in it more for the long term. That's kind of my style. So
okay. All right. Let's see. We hit energy. Let's move on to the precious metals. Let's move on to gold.
Yeah. So gold is also seeing some interesting moves today. Just hovering right under 2100. We're at 2095 at the moment. And I don't know about you, but I don't know what you call this. What, a 1, 2, 3, 4, 5, a pentatop? Is that
a quintuple top? Yes.
A pentatop. So, gold, I don't know how much of a coiled spring more you can get with gold. And so gold had a big move today. So this is on a weekly candlestick. Let's look at the daily for a bit. Yeah, here's your big green daily candlestick. We haven't seen anything this big since earlier or later last year, back in October.
Yeah.
We saw, so some pretty good momentum on the gold front. And despite this huge move today, you're still pretty down on your moving average. You still have a lot of move to run up before you get into that danger zone in your moving average. So I think this is really interesting, because when gold hit its highs up here, you were still around this 6% range, but now you're at a 2% range.
Yeah.
At this top here, you're kind of comparing it with previous times. You're at a 4.5%. So gold is here. You're at 10%, and then here you were at 14%. So I just get the sense that gold wants to break out. And if you'll recall, in 2020, gold led inflation. Gold broke out a year before you started seeing these massive CPI prints.
Yeah.
And so what this is telling me is that if we do see a breakout, then this is a leading indicator for your second wave of inflation, so to speak.
Yeah.
Gold sniffing something out.
Yeah. Okay. And how are you playing the gold sector?
So with gold, again, I just have a mixture of gold and silver stocks
Okay.
as
Okay.
well. So just a basket of miners.
Okay. Okay. And are you focusing mostly on the majors or the juniors, or kind of a mix of both?
It's kind of mid caps.
Okay.
That's kind of my strategy. Even like with all these different stocks, I don't play around too much with the smaller cap stocks. I don't speculate with explorers and stuff like that. But I will try to get some extra torque more so than I would investing in the producers by investing in developers and mid caps and so forth.
Okay. Okay. All right. And let's round out with silver.
Oh, silver. So let's actually let's pull up the silver to gold ratio. Let's see how that's looking like.
Okay.
And why this is so important is because typically when silver outperforms gold, that's your sign that you're in a precious metals bull market, right? It's because money is flowing to the more risky investment. So there's so much confidence in the precious metals that money takes that confidence and is able to buy further out the risk curve. Now, what are we seeing today? Really not that much action. If you look at this from a decades long view, we're still moving kind of sideways here on the silver to gold ratio. But if you look at silver in isolation, we're sitting at 23, 26. We had a pretty decent day today. Silver saw a 2.5% move today, whereas gold saw a 2% move. So a slight overperformance of silver. That's what you want to see in these precious metals bull markets. So we'll see when we get there. But right now, we've just been holding steady, and we're squeezing this little wedge pattern here. We need to break out of this $24 level, break through this $25 level, and then you'll be off to the races. But right now, just another. I don't want to say day because we did have an update today in silver, but it's wait and see. It's wait and see. So once gold moves significantly, that's when the money starts flowing into silver afterwards. There's a sequence of events.
Yeah.
So what'll happen? Yeah. So what'll happen is the average person will see gold move up significantly, and they'll try and FOMO in by capturing silver. You see this happen in the crypto space as well. When Bitcoin moves up to like $63,000 a day or a week later, you start seeing these shit coins move up as well. Dogecoin had like a 40% move or something.
Oh, that stuff is still around?
Yeah, it's still around.
Okay.
This is the mindset of you got to think in the mindset of retail. So I mean, they don't care about fundamental analysis, fundamentals, or anything of that nature, or technicals. It's just it's being treated as a casino.
They still think NFTs are going to come back. Okay. All right. Let's see. So, you also have a commodity versus S&P chart?
Yeah. So I pulled up so this is the Goldman Sachs commodity index, and we're playing it off against the S&P. Okay. So this is pricing in the commodities complex relative to the stock market. And what you'll notice is that we've been in a secular bear market for 40 plus years. So capital has been flowing into growth, the S&P, et cetera, more so versus commodities. Now, we did have a pretty decent rise in the commodities price and the commodity index price here from 2020, from the bottom here in 2020, all the way to the top, 2.5x move. But we've corrected a significant margin down. And even if with that huge rise up that we saw in 2020, it's still nothing compared to the top here, right? Yeah. You're sitting at a ratio now. Kind of put it in perspective. This is a log scale. So once I unlog it, you'll see what I'm talking about. This is where you're at.
Yeah.
Right. Your ratio is sitting at 0.11. And the percent allocation of capital in the commodity complex in the 1980s was 20 times more than it is today.
That's incredible.
Right. So this is, you're sitting all the way down here. Yeah. A 2000% move to back to that top. So this is why I'm in commodities. This is why I look at energy, is because, we've been down in the dumps for quite a while. You could make the case, okay, well, listen, Danny, you could have made this case back in 2000. Okay, well, fine. But in 2000, you had a commodity bull run, right?
Yeah.
From 2000 to 2008, had a pretty significant rise. Am I saying we're going to go back to that top? No, but all I'm saying is that there's huge asymmetry.
Yeah.
And so even if we capture even half of that move or a quarter of that move, that's still good enough for me.
Yeah. Yeah. That's still an incredible move. Okay. So of all the commodities that you follow, all the guests that you interview, what is your highest conviction bet, highest conviction commodity for 2024?
Interesting. Highest conviction bet. I want to say my oil services stocks from a conviction point of view. Now, risk reward, what I think has the most upside, but a little bit more risk is probably your uranium stocks. But if you really want to get out there, go off the risk curve, then again, nat gas and coal stocks is where I think if they do run, they'll probably outshine everyone.
Okay. All right. So you think as far as safety, probably oil, although not as much upside. If you want to go out on the risk curve a little bit more and have a higher return, but also you could lose more, uranium.
Yeah.
Okay.
And then even further out is natural gas and coal.
Okay. Awesome. Well, thank you very much, Danny. If people want to follow you, we'll put your YouTube channel in the pinned comment below. Is there any final thoughts you have?
Yeah, I mean, I appreciate coming on. This was fun. Thank you so much for the time, Steve. You can find me on the Capital Cosm YouTube channel. We cover a lot of the same stuff that Steve does here. We also have a lot of the same guests. Concluding thoughts, I would say, is sometimes less is more. What I mean by that is I'll see a lot of people just consume so much content. I'm guilty of it too, but it comes to the point of analysis paralysis where they don't know what decisions to make. And sometimes you just got to take a step back and take time to digest and look at and identify what's signal and what's noise. And I see this a lot, like with the uranium space. The uranium community is very vocal when it comes to pullbacks, when it comes to jumps up in the price. It's a very emotional roller coaster in the uranium community. And I hear so much vitriol against uranium now just because it's gone all the way down to $94. But if you were investing in this stuff for years, I find it kind of hard to believe you haven't made money in some form or fashion. You know what I mean?
Oh yeah. Like you were betting on the wrong stocks if you haven't made money in the last couple of years.
Unless you just bought in 2021. But even if you bought in 2021, you're still moving sideways. But there's opportunity cost with time. But if you bought in early enough, which I see a lot of people claim to have bought in 2017, 2018, 2019, complaining about the uranium price. It's like, yeah, like, how are you guys not up? Or like, are you like, I don't understand.
Yeah. Well, thank you, Danny. And we'll put a link to your channel in the pinned comment below. You interview a lot of the same people we do, and I think that our listeners will find it helpful just like I have. Thank you for tuning in. Hit the like and subscribe, and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.